Hello, I'm Wade McElwain, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. No doubt, these are exciting days for tech stocks. Investors, big and small, are dabbling in the sector. Last week, a buying frenzy in Airbnb's and DoorDash's IPO yielded a first-day gain of 113 and 86% respectively, and traders are partying like it's 1999 again. When the market is focused on these high-flying stocks, attention is naturally diverted from other sectors, overlooked sectors that are producing equally strong gains. For example, did you know that copper recently soared to new 5-year highs? Just this month, iron ore rose to its highest level since 2013, and nickel is at a 1-year high too. Traders may think this is counterintuitive, so why would industrial metal prices go up when a huge swath of industries are shut down due to COVID-19? Didn't West Texas oil hit a minus $37 back in April? Well, markets have a habit of confounding expectations. Back in March, we saw a wave of indiscriminate selling of stocks. Nobody wanted to hold risky assets, and certainly not oil, as major transport networks ground to a standstill. Now the sentiment has turned. Look where the crude oil is currently trading, above $50 a barrel. The point is, there is a stealth rally taking place among miners right now, a rally that is happening under the radar. BHP, arguably the largest miner in the world, rallied to a 6-year high, as did Rio Tinto, with two very technically powerful breakouts. Southern Copper, a $46 billion integrated copper producer with mines in Mexico and South America, rose from $24 in March to $60. Look at Freeport-McMoRan, a $35 billion miner with large interests in copper. From its March lows of $5, Freeport advanced into a strong bull trend and currently trades at $25, a gain of 370%. Even tech stocks would have a hard time matching these returns. What is going on in the commodity world? Is this a return of a so-called commodity supercycle? Well, there are two reasons for the unexpected boom in commodities. The first is quantitative easing. The scale of quantitative easing this year is huge. During March to June, the Federal Reserve alone increased its balance sheet by an astronomical $3 trillion. In other words, in just 90 days, the U.S. Central Bank reflated the financial markets more than all the banking rescue operations combined in the previous 7 years from 2008 to 2015. In addition, the Fed is buying another $80 billion worth of bonds every month to keep the economy flowing smoothly. All this liquidity has to go somewhere. Part of it went to stocks, especially tech stocks, which is why the U.S. stock market recovered so quickly. And part of it flowed to monetary-related commodities such as gold and silver. It is no coincidence that gold prices soared from $1,500 per troy ounce in March to over $2,000 in August. As soon as the Fed stopped expanding its balance sheet aggressively in July, gold stopped going up. Trackstar IQ, our proprietary search tracking tool, shows us that institutional Wall Street investors have been paying keen attention in gold and silver futures and ETFs in the past month. Now, as the global economy gradually recovers from the pandemic and the ocean of liquidity is flowing from gold into industrial metals such as copper, nickel, and iron ore. Another reason that industrial metals are in demand is due to the pivot into a green economy. Governments around the world are trying to retire diesel and petrol cars to reduce carbon footprints. They aim to replace combustion cars with electric vehicles that are powered by rechargeable batteries. But did you know that these electric cars use 80% more copper than traditional petrol cars? Not only that, car batteries rely heavily on lithium. This commodity is seen as the white oil because of its importance in propelling electric cars. A Tesla 3 sedan has more than 4,000 lithium cells. As millions of petrol and diesel cars are slowly being phased out and set to be replaced by electric vehicles, can you imagine the scale of lithium demand in the next decade? Furthermore, the lack of scalable alternative to lithium means the car sector will continue to drive the market higher in the years to come. No wonder lithium miners went through the roof recently as investors scrambled to buy into the lithium growth thesis. Trackstar IQ also confirms this investor interest, showing growing interest in the Global X Lithium ETF over the past month. Albemarle, one of the largest lithium miners in the world, jumped 40% over the past 5 weeks. Another related stock, Sociedad Químico, also enjoyed a strong rally. So, what is the market trying to tell us? Well, Stocks often break higher when no one is looking. The rally in miners is one such example. The other point is that a sector rotation may be taking place. Smart money could be moving aggressively into mining stocks while others are still glued to the tech sector. Keep your eyes peeled. That's all the time we have for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.